Hi, Mitchell here from CSOP Asset Management again. In order to expand on our product offerings to better help investors in their asset allocation needs, we have recently rolled out a pair of Asia's first virtual asset ETFs, namely the CSOP Bitcoin Futures ETF and the CSOP Ether Futures ETF, under tickers 3066 and 3068 respectively, and are listed on the Hong Kong Stock Exchange. These are futures-based ETFs that aim to track the price movements of the two respective underlying virtual assets. Since the conceptual stage of Bitcoin back in 2008 and Ethereum in 2013, the demand for virtual assets have grown rapidly and ballooned to around $1 trillion in market capitalization, with over 10,000 types of products on offer within this space of this time. As a result, Bitcoin and Ethereum have become the gold standards, or the so-called blue chips, within the new asset class. We've seen more and more institutions and governments recognizing these two virtual assets as legitimate alternative means to store value, making this emerging asset class just too big to ignore and with great potential to grow even further. More countries and governments have allowed virtual assets as a means of payment for goods and services, and central banks are also increasingly recognizing them as essential asset class. And at the end of 2022, even the BIS have progressed to allowing banks to hold up to 2% of their reserves in Bitcoin. Some banks around the world have also already allowed crypto trading, such as Commonwealth Bank, which is the largest commercial bank in Australia, offering customers the ability to buy, sell, and custodize virtual assets. PayPal, a popular US payment service provider, have also allowed trading various virtual assets on its app and website. Therefore, examples as such have already significantly contributed towards increasing fund flows and trading activities in the last few years alone, with funds into virtual assets growing from $75 million in 2019 to just under $8 billion in 2021, and turnover ballooning from around $12 billion to $245 billion in the same time span. Now, what are these two virtual assets themselves? Although they both use blockchain technology, there are some key differences between them. In short, Bitcoin is a virtual decentralized asset that is best recognized for its potential in being a great storage of value due to its limited and ever-dwindling supply. Due to its limited supply, some believe it to be even rarer than gold itself. By design, the supply is capped at 21 million Bitcoins, with the current amount already buying at around just over 19 million as of the end of 2022. Furthermore, it gets costlier and more difficult to mine additional Bitcoins as supply increases, where the number of Bitcoins being rewarded for each successful mining gets halved every 4 years or so. Ethereum, on the other hand, is a decentralized software platform where developers can leverage smart contracts in order to develop decentralized applications and fungible or non-fungible tokens. Although unlike Bitcoin, the total amount of Ethereum created can be unlimited, which may take away the rarity factor as a result. However, its competitive advantage comes from its use cases for its smart contracts and high development potential for its application scenarios. So why use ETFs to track the performances of these two decentralized virtual assets? Well, firstly, ETFs buy into futures contracts that are traded on the Chicago Mercantile Exchange, which is the largest derivatives exchange in the world, making it highly liquid and regulated. This is to an extent eliminates the counterparty risk as seen in recent times with physical crypto exchanges. Futures contracts are cash settled and closely track the price movement and sentiment of the underlying physical assets, allowing investors to participate in the price movements of these respective virtual assets under a regulated environment, as current physical crypto exchanges are yet to be regulated by government bodies around the world. Bitcoin and Ethereum futures contracts are also among the most actively traded contracts traded on the CME, with Bitcoin trading at more than 10,000 contracts per day as of the end of 2022. On top of the regulations overseeing the CME, ETFs listed in Hong Kong are also traded on the Hong Kong Stock Exchange and are SFC regulated, adding an extra layer of governance for investors. And the Hong Kong government have also expressed their commitment on making Hong Kong a virtual asset hub for international companies and investors, making Hong Kong Stock Exchange a favorable listing venue. Using ETFs to trade and track virtual assets is also as easy as buying and selling stocks without having to go through the hassle and tedious process of account opening and cash transfers as compared to the crypto exchanges. And increasingly so, these can also be custodized in traditional brokerages and banks, which enables virtual assets to be incorporated into portfolio construction and asset allocation needs. The transparent nature of ETFs can also make it easier to track and incorporate into portfolios as well. Therefore, our new CSOP Bitcoin Futures ETF and CSOP Ethers Futures ETF provide extra tools for investors to further diversify their portfolios and asset allocation needs by investing into this fast-growing and exciting virtual asset space. However, investors are recommended to read through the prospectus or the relevant disclaimers in order to understand the underlying risks involved before doing so. Hope these two new products can further help investors diversify their portfolios, or that you found this video informative at the very least. In order to get more information, please visit our company website at www.csopasset.com, and don't forget to like and subscribe to our channels to get the latest info on our products and market developments. Thank you.